common question I hear is, when should I start investing? And it's a good question, but it has an even better answer. Right now. The sooner, the better. And this is because of a concept called compound interest. What is compound interest? It is simply interest on interest. To give you an example how compound interest works and how powerful it really is, let's look at this example. This is called a future value chart. As you can see here, you put in a present value, which is your starting amount, and the number of periods. This is going to be 45 years, and your expected return. We're using 6%, which is a fairly conservative historical average of the stock market. So let's say a 20-year-old invests $1,000 at a 6% expected return for 45 years. So by the time they're 65 years old, that $1,000 would have become over $13,500. That's the power of compound interest. Now let's say that that same 20-year-old, instead of putting away $1,000 at the beginning of the 45 years, they put $180 a year, or that's $15 a month, away for the same 45 years at an expected 6% interest. So $15 a month, 45 years, 6% interest, that becomes over $38,000. I'm sure that we all have $15 a month to put away for a better future. And that leads directly into our next class's topic, dollar cost averaging. That's all I got for you today. See you next time.